Welcome back to the Pro Ticker Podcast, your Tuesday morning edition covering major financial magazine headlines, everyone. You've sent us quite a stack of sources today. We're looking at Bloomberg, Barron's, and the Wall Street Journal. Our mission, well, as always, is to sift through this mountain of information, pull out those really crucial nuggets, and hopefully deliver those aha moments that make you feel genuinely well-informed, without the overload. We're looking at a pretty fascinating snapshot of the global financial landscape this morning. We'll be diving into major economic policy shifts, dissecting market sentiment a bit, and exploring some individual corporate strategies, too. It's definitely a busy morning out there.
It really is. And what's truly striking, I think, is how interwoven all these narratives are. We're going to see how decisions made in Washington or, peace talks happening over in Europe create these tangible ripples that impact everything from tech stocks right down to bond yields and, yes, even like your local utility company or that home improvement retailer down the street. It's all connected.
Okay, let's kick things off then with some big picture economics, specifically how government policies are reshaping the global stage. First up, the U.S. credit rating. Bloomberg reporting that S&P Global Ratings has just affirmed the U.S.'s AA+ long-term rating stable outlook.
Yeah, and that affirmation is significant.
Yeah.
Because S&P specifically noted that revenues from President Donald Trump's tariffs, which actually hit a fresh monthly record, $28 billion in July, apparently.
Yeah.
Those revenues are expected to help offset the fiscal impact of, recent tax cuts and increased spending.
So S&P is basically saying these tariffs are actually a meaningful contributor to the national budget. That seems like a strong endorsement for one of the president's key arguments.
It is, but it also raises that important question, doesn't it?
The inherent tension, you mean?
Exactly.
Yeah.
While the tariffs are generating revenue now, Bloomberg also points out the contradiction in the policy. The administration also champions Buy America, bringing production back to the U.S.
Right.
Which, if successful, would eventually undercut future tariff receipts.
So how do they reconcile that? It feels like a paradox.
It's a classic policy paradox, isn't it? As Bloomberg points out, the immediate revenue boost is, undeniable. But you're right. If the Buy America initiatives genuinely succeed in reducing imports, then the very source of that tariff revenue starts to diminish. The deeper insight here, I think, is that the administration is navigating a short-term fiscal gain against a stated long-term industrial policy. It sets up a really complex future trade-off that analysts are watching very closely.
And speaking of tariffs, another Bloomberg report reveals what might be an unintended consequence. Trump's tariff war seems to be accelerating Beijing's trade and investment push into the global south. We're talking nations across Southeast Asia, Latin America, the Middle East.
Yeah, this is where we potentially see a kind of reordering of global commerce. China's goods exports to these regions have actually doubled over the past decade. That significantly outpaces their growth to the U.S. and Western Europe. S&P Global economists are even suggesting this could lead to a new order where South trade with Chinese multinationals really at its core becomes the new economic center of gravity. It shows how even punitive measures can sometimes provoke strategic reorientation rather than just deterrence.
So instead of being deterred, China is strategically leveraging these tariffs to deepen new trade relationships elsewhere.
Precisely. Chinese officials are actively reducing trade barriers, signing new deals. For instance, President Xi Jinping's recent move to eliminate import tariffs for almost all African nations, that's a major signal. However, it's not all smooth sailing. Local industries in the global south are already starting to push back against what they see as, a flood of cheap imports. It's a complex dynamic, definitely has two sides.
And adding to the complexities, especially for trade professionals, Bloomberg also reported just yesterday that Trump widened those metal tariffs. Now includes over 400 consumer items, everything from baby gear to motorcycles. Apparently, the logistics industry was stunned.
Oh, absolutely. What's truly impactful here is the speed and the breadth of the implementation. The new list went into effect on Monday with, virtually no notice, even for goods already in transit.
Wow.
This creates massive, fresh headaches, as Bloomberg put it, for trade professionals. Flexport, the digital freight forwarder, highlighted the significant compliance burden. It's forcing companies to scramble, chasing suppliers for detailed data on metal content. As one customs broker frankly told Bloomberg, American companies employing American people are feeling, quote, ambushed by their own government by these sudden, expansive changes.
Okay, let's shift focus a bit, moving away from trade wars to maybe the positive impact of geopolitical developments. Bloomberg also reports that Europe's emerging market assets are gaining significant ground, seems due to progress in Ukraine peace talks.
This is a really powerful direct market reaction. The meeting between President Trump, Ukraine's Volodymyr Zelensky and European leaders in Washington seems to have created a wave of optimism. Piotr Matas, a currency analyst at InTouch Capital Markets, pointed to Central and Eastern European currencies as the, quote, main beneficiaries of this sentiment. We saw the Hungarian forint hit an 11-month high against the euro, and Ukraine's dollar bonds were leading gains across emerging markets. It just demonstrates how rapidly diplomatic efforts can translate into tangible market shifts and, increased investor confidence.
That's a very clear illustration, isn't it, how global politics directly impacts investment flows. But across the globe, in Japan, Bloomberg is flagging some, let's say, lingering fiscal concerns.
Indeed. Japan's recent 20-year government bond auction showed weaker demand than its 12-month average. This is usually a telltale sign of investor caution about longer-dated debt, especially with fiscal risks like higher government spending and potential tax cuts looming. This concern is heightened, remember, after the ruling coalition lost its majority in the upper house election. It casts a bit of a shadow on the Bank of Japan's ongoing efforts to rein in bond purchases. The bond market seems to be signaling maybe a lack of confidence in the government's fiscal path forward.
So political uncertainty in Japan is creating real ripples in their bond markets, and analysts are noting something quite interesting. The 20-year sector yielding about 1% more than the 10-year. What does that yield curve imply for the Bank of Japan's next meeting? Is it significant?
Oh, it's a crucial signal. A wider gap between long and short-term yields often suggests the market expects future economic shifts, potentially including rate hikes down the line. The fact that the 20-year is yielding significantly more than the 10-year indicates that the Bank of Japan's next meeting could still be, quote, live for a rate hike, meaning they might be forced to act sooner than perhaps some anticipate to address these lingering fiscal risks and investor concerns.
Okay, and these macroeconomic currents, they inevitably ripple into specific sectors. None more captivating right now, perhaps, than tech. Market sentiment there is really divided. Barron's and Bloomberg reports are actively discussing whether we're seeing an AI bubble.
It's definitely the hot topic, isn't it? The NASDAQ 100 index is up almost 40% since its early April plunge, largely propelled by the Magnificent Seven index. Apple, Microsoft, NVIDIA, Amazon, Alphabet, Meta, Tesla, which has soared nearly 50% since its April 8 bottom, according to Bloomberg.
Yeah.
But here's the kicker. Sam Altman, the CEO of OpenAI, actually told The Verge that he thinks the AI market is in a bubble, even as he steadfastly affirms AI's transformative importance.
An AI bubble comment from the CEO of OpenAI himself, that's quite the statement, suggests maybe an internal awareness of, unsustainable valuations. So what does this candid admission mean for investors trying to navigate this sector?
It certainly adds a layer of caution, yeah. Bloomberg highlights that options traders are already bracing for a potential sell-off. Their buying disaster puts on the Invesco QQQ Trust Series 1 ETF, the one that tracks the NASDAQ 100.
Insurance, basically.
Exactly. They're essentially insurance policies against a sharp, catastrophic downturn. And the measure for hedging against a sharp versus a smaller downturn is at an almost 3-year high. This indicates a kind of deep-seated fear that tech stocks might be following a pattern surprisingly similar to the dot-com bubble of the late 1990s, as Torsten Slok at Apollo Management noted. The aha moment here is maybe that the market's internal hedging mechanisms are signaling a potential reevaluation, not just some minor correction.
And these concerns aren't just theoretical, right? There are potential triggers on the horizon, like the Federal Reserve's Jackson Hole Symposium starting in a few days.
Right, that's key.
A major event where central bankers discuss monetary policy. And then NVIDIA's highly anticipated earnings report next week.
Exactly. As Jeff Jacobson, a strategist at 22V Research Group, put it in the Bloomberg piece, a myriad of things could send big tech tumbling. This includes concerns about AI's ultimate impact on software companies' profitability, or maybe if those recently widened metal tariffs we talked about, if they lead to higher inflation, for example, that could force the Fed to curtail the interest rate cuts that the market has already optimistically priced in. It's a really delicate balance right now.
Okay, from the, let's say, often frothy tech sector, let's turn to the crypto market. Barron's tells us that Bitcoin and other cryptocurrencies are mixed this Tuesday, still showing that volatility we've come to expect.
Yeah, Bitcoin itself was down 0.2% over the past 24 hours, trading around $115,064. Though, it did hit that record high of over $124,000 just last week. The entire sector remains heavily influenced by expectations for interest rate cuts from the Fed. Lower rates typically make riskier assets like crypto seem more attractive. However, optimism has been dampened a bit by recent wholesale price data and also Treasury Secretary Scott Bessent's statement that the U.S. doesn't plan to acquire more crypto for its Bitcoin reserve.
Interesting.
Yeah. And while most major altcoins were falling, XRP notably gained about 1.5%, showing some individual coin resilience there.
And despite this ongoing volatility, Barron's points out there's still a, quote, rush of crypto companies aiming for an initial public offering. Gemini, founded by the Winklevoss twins, just filed for an IPO. What does this tell us about the long-term outlook for crypto if companies are still pushing for public listings in such a mixed, volatile market?
I think this really gets to the core of the institutional adoption narrative. It suggests that despite the price swings and the regulatory uncertainties, a segment of the market, and these companies, views crypto less as just a speculative fad and more as an established long-term asset class, something with underlying infrastructure potential. Joel Kruger of LMAX Group noted the sector remains vulnerable to rate decision outcomes and policy shifts. Absolutely. But the IPO push reflects a strategic pivot towards broader institutional integration. These companies are betting on the fundamental technology and the long-term utility, really beyond just the daily price movements. That's the real shift, I think.
Okay, let's pivot again, this time to the retail sector. Home Depot stock slipped today. Barron's explains why earnings disappointed investors.
Yeah, Home Depot reported weaker than expected quarterly earnings and sales. Shares fell about 0.4% after its same-store sales climbed only 1% against an expected 1.3%. It's a pretty clear signal that the full rebound for home improvement, well, it isn't quite here yet. The company did stick by its full-year guidance, which forecasts a modest 1% same-store sales growth, but also a 2% decline in adjusted earnings per share.
And this connects directly to the broader housing market, doesn't it? Is there any sort of hidden opportunity here, or is it just waiting game?
Absolutely, it's closely tied. Home improvement demand hinges on the housing market's strength. The current standstill, often called the lock-in effect, higher interest rates deterring homeowners from selling homes at those nice low-rate mortgages, that continues to pressure companies like Home Depot and Lowe's. However, while sales have been soft, analysts are looking ahead to the housing market's eventual inflection, perhaps driven by future rate cuts. But here's the interesting part, as Telsey Advisory Group points out. Rising home equity values since 2019 mean homeowners actually have a significant source of wealth they could tap for remodeling projects.
Ah, right.
So the potential for a delayed but maybe significant wave of renovation spending is still very much on the table once interest rates maybe provide a clearer path forward.
Let's dive into some specific corporate strategies now and investment trends making headlines. We start with Anglian Water, a major UK utility facing some pretty significant challenges.
Yeah, a Bloomberg report details that Anglian Water is selling its first sterling-denominated benchmark bond in almost a year. They're essentially testing investor appetite right now, and this comes just weeks after the UK regulator, Ofwat, proposed a hefty $62.8 million enforcement package against the company. This was for serious failures in managing its wastewater treatment network. It's a very public challenge to their operations.
That's a substantial fine and a real blow to their reputation, I imagine. How are they navigating this, both the financial hit and the operational hurdle?
Well, the company has pledged to rectify these breaches, and they've committed $100 million in 2024 specifically to curb pollution. But crucially, their shareholders agreed back in May to inject $500 million of fresh equity. $300 million of that is due by early next month. This equity backstop was key. It actually prompted Moody's to revise Anglian Water's outlook to stable from negative. It reflects strong shareholder support and a clear commitment to reducing leverage. So it shows a utility facing immense public and regulatory pressure, but importantly, with strong financial backing to address the issues head-on.
Now, here's an intriguing one. Activist investors making waves, but in a sector you might not always expect. The Wall Street Journal reports that Medtronic, the medical device giant, is adding directors to its board. This comes after Elliott Investment Management became one of its largest shareholders.
Indeed. Elliott, they're known for their aggressive, sort of value-oriented approach, mostly in tech and energy historically. But we're seeing them increasingly active in healthcare now. Apparently, the talks between Elliott and Medtronic have been described as friendly, focusing on boosting the company's valuation, which, despite a 16% rise this year, is still seen by some as undervalued, especially for the global revenue leader in medtech.
Right.
So Medtronic plans to announce 2 new independent directors and form special committees. These will focus on growth, M&A, R&D, potential divestitures, and boosting earnings. This isn't just a minor board reshuffle. It reflects, a strategic pivot, the kind you often see when an activist investor pushes for a more focused, shareholder-centric approach.
So Elliott is essentially nudging, or maybe pushing, for a more proactive strategy at a major healthcare company. Interesting. And shifting gears again to commodities, Bloomberg tells us Trafigura, one of the world's largest commodity traders, is making a deeper push into gold and silver. It's intriguing to see a company known for industrial metals moving into precious ones. What's driving this diversification? Is it just profit chasing?
Well, it's certainly a savvy move driven by soaring prices. Trafigura has hired a dedicated team of precious metals traders to venture further into these highly profitable markets. They're focusing initially on gold and silver doré, which are those semi-processed bars. Gold prices, as you know, are at successive records, just above $3,500 an ounce, and silver has rallied to decade-plus highs. It just makes precious metals significant profit drivers for these big trading houses right now. What this tells us, I think, is that commodity trading giants are leveraging their vast cash piles and their market expertise to exploit new profit centers, especially as gold and silver have become such, go-to safe haven assets amidst all the tariff wars and geopolitical tensions we've been discussing.
So it's not just about profit then. It's also about strategic positioning in a pretty volatile global economy.
Exactly. And if we connect this to the bigger picture, it's also about accessing more clients, structuring financing deals beyond their traditional focus on copper and aluminum. The market for refined bullion bars is usually dominated by the large global banks. So Trafigura's move could definitely shake things up a bit, bringing a new powerhouse player into the precious metals space.
Okay, finally, another intriguing investment trend from Bloomberg. Macquarie is partnering with Endows to offer private infrastructure assets. This sounds like a significant shift in who can actually access these kinds of investments. Democratization, maybe.
It absolutely is. This initiative aims to make private infrastructure investments things traditionally reserved for large institutions, pension funds, endowments accessible to eligible individual investors, specifically in Singapore and Hong Kong, via a digital wealth management platform. This definitely boosts those broader efforts to democratize private credit and alternative assets. BlackRock CEO Larry Fink has famously pledged to open up this burgeoning asset class to millions of everyday investors, and this partnership is a really concrete step in that direction.
That does feel like a game changer. Breaking down barriers for individual investors to tap into a sector like private infrastructure, which, as the report notes, has grown fourfold in a decade to $1.3 trillion in assets under management. What makes this asset class so attractive right now that we're seeing this big push for wider access?
Is a crucial question for anyone thinking about their investment portfolio long-term. The growth in private infrastructure is fueled by several powerful long-term trends. Think decarbonization, which demands huge investment in new energy infrastructure. Think digitization, requiring more data centers, more connectivity, and shifting demographics, accelerating demand for new urban and social infrastructure like hospitals or transport. These are all massive macro forces driving significant sustained investment. It makes private infrastructure appealing for long-term capital that could potentially withstand public market volatility a bit better.
Okay, so wrapping up, what does all this mean for you? Today's deep dive into these financial headlines, I think it truly highlights the complex, interconnected nature of global markets. It's fascinating. We've seen the surprising ripple effects of tariffs maybe creating new trade orders, the direct impact of geopolitical talks on emerging markets, the internal workings of corporate governance under activist pressure, and the exciting yet, sometimes bubbly world of tech and crypto.
Yeah, what really stands out is just how quickly market dynamics can shift. In response to both those big macro events like trade wars and peace talks, and also micro-corporate decisions like a utility company's response to fines or a medical device maker's board changes prompted by an investor. The continuous interplay between policy, innovation, and crucially, investor sentiment that shapes the opportunities and the risks for everyone involved.
It's a powerful reminder, isn't it? That being well-informed isn't just about knowing the individual facts, but really understanding that intricate web that connects them all. Keep pondering how these large-scale movements and these individual corporate plays might influence your own financial landscape and the opportunities ahead. We'll see you all tomorrow morning with new headlines from major financial magazines.